Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So talk about a straddle on the euro. Go ahead and buy some EUI puts and go ahead and I'm sorry, that's a typo there. Go ahead and also buy some EUI calls as well. That should say long, it says short. My apologies for that. And so at any rate, so that's how you could put on a straddle. If you wanted to short a straddle, you would go ahead and sell an EUI put and go and sell an EUI call. You're putting out a viewpoint that you think the market's going to stay within a certain range. And then of course, based on where the market is, this is a short gamma strategy. If you're selling a straddle, it's a short gamma strategy, meaning that the more the market goes up, the shorter you become. So if the market begins to rally, you actually become de facto or technically, short the market as it begins to rally. And the more the market rallies, the shorter you become. Or if the market begins to break down and go down, the more the market goes down, actually the longer you become because you're banking on a trading range. And so depending on how you want to babysit, that position or manage that position, that's where we talk about, delta hedging or gamma scalping to offset your risk while you're picking up that time decay. And this is a pretty common practice used by a lot of, guys out there, that a lot of options makers they'll just flat out edge and hedge. They have their models that come in and price options at a certain point, and then based on what the market does, they'll maneuver around that and take a viewpoint. Or if they happen to have a viewpoint on the market, in theory, a lot of market makers and specialists, want to be delta neutral, but in practice, it's an awfully difficult thing to do. To not have some even minimal exposure out there, just based on the fluctuations and movements of what takes place. Calendar spreads, just because I talked about it, I want to give you guys a sense. Again, bear with me on these prices because I put these in here on last Thursday night on New Year's Eve to submit it in time to get this presentation ready through the compliance part. But selling an option in the same vehicle in 1 month while purchasing an option in a more distant month. So you can sell a January Euro 70 call, the EUZ, for 53 cents, and buy a February one for 70 cents, or buy a 70 call for $1.20, or a 67-cent debit. This takes on a bit of a straddle, if you're short a straddle dynamic, except you're hedged out with the upside because you bought a commensurate number of contracts. It's different from being naked because you end up benefiting from the Fed, and again, like I talked about, being hurt by if the Vega happens to drop. The Vega is a little more impactful the farther out you go. So if you're selling, let's say, the January call and you buy the June call, and implied vol takes a dump, you can definitely get hurt on the longer end of that. A little bit about what the options structure looks like right now. When we look at implied vols out there, here's your volatility structure here in terms of what's setting up in the implieds across these levels. Now, to be quite candid, okay, when we look down, at the euro, 122 or 121, for within this month, to see implied vol at 50, that's more of a dynamic of just the bid-ask spread. You might be able to get a tick or a few ticks for that, but that's not so representational of that. But what is worth noting in here is the steepness of this of the euro puts, and how there is a bit of more of a bid in the euro puts than there are in more or less how less steep the call curve is. So the put curve is definitely steeper than the call curve is, and that's not so untypical, but it's still something worth noting. There's a bit of a greater demand out there for the put side of this long carry trade than there is for the long side, or than for the call side of this long carry trade. And that's a function of some of the hedging that goes on, and just also some of the premium people pay for insurance, and what that euro US dollar trade has become to represent. If you go ahead and look at your ISE options and throw those options into your options analytics, you'll see this same chart, and it sets up some different ways to play this market. Which, again, when I go in, one of the great parts about doing if I can just talk for a second here, it hasn't stopped me the last 30 minutes, why would it stop me now? If you look at, when I went and worked with, and why I like working with exchanges, because of the chance to meet and collaborate with other traders, other money managers out there who want to, who want to learn and want to improve. I've definitely learned and want to improve. I'm slated to go to a Bloomberg class later on this week to learn about, using that terminal. That you never stop learning as a trader. I'm always constantly talking with software providers out there, trying to get an edge, trying to learn something, trying to get better, trying to extract something. And folks, this process should never stop. But the point I'm talking about, what I want to touch on is that from being a person that trades a lot of options, that actually comes across to being a spread trader as well. And so, looks like I have a question here. Okay. So that's how you can trade that as well. And again, looking at the euro, looking at the EUU is another way that you can trade that. But you see here just how soft that curve is going up and how steep that curve is on the put side. It's something that we keep in mind in that regard. I got off subject, but I want to make sure I get in this presentation here. So now we've taken the steepness of that put curve, or of that curve for the Nasdaq, and now the EP is a symbol for the S&P, okay, or the SPY. You can trade those SPYs through the ISE as well. But you look how soft this is, and just how much more complacency is built in the equity markets than there is during the currency markets. And it's my contention. All right, here's some what I hope is some value at. All right, it's my contention in feeling in a positive situation that the currencies have done a great job of leading this market over the last year and a half or so, and it's not, and based on that, you see this type of dynamic. In other words, the vol curve from the S&P right now there's just a lot more complacency priced in here. Implied vols are obviously not as high as they are in the euro. We're talking two amazingly liquid and deep products out there. So whether it's the EUU or whether it's the SPY, okay, and the options on the SPY, it's my contention that you can go out there and literally, go long volatility on the equities right now and begin to go short volatility on the currency markets. And so by doing that, you've taken a much different perspective on how you can set things up. So what I'm doing right now, what I'm phasing into, is beginning to go long straddles on the S&P and beginning to short straddles and strangles and begin to sell options on the euro, British pound, Japanese yen, and take that from there. Now, for some people who are not necessarily comfortable being naked calls or naked puts, we've seen from correlation that doesn't mean correlation holds up. And again, I'm not saying that my strategy, that's why we have the risk disclosures here. But in terms of, you can put on a call spread and a put spread. So maybe you want to put on an iron counter. So go long a call spread on the S&P, go long a put spread on the S&P where you buy the at the money call, sell out of the money call. You buy an at the money put, sell out of the money put. Now, most people that put on spreads actually, I'm not going to generalize, but work it as far as working in that way. So in terms of talking about that put spreads, the simultaneous purchase of a sale at a higher price put and lower price put during the same month, the owner of the bear put spread will buy the higher price put and sell the lower price put, incurring a debit to the account. So let's put this to practice here, okay? We have, again, looking at how that would play out on the euro. Again, I want to show you just a little bit about what we saw back in 2008. So let's take a look at how I'm balancing volatility for Q1 of 2010. This is the nuts and bolts of this here. Long volatility on equities. Again, because like I talked about, I'm a little bit bearish the market right now, and I think that volatility is going to kick up again. But if I'm wrong, I think I'm playing this in the right way. Okay, I think that a lot of the currency damage has been done in terms of where the meat of that move has happened. It doesn't mean that another leg lower can happen, but I think on the equities front that things are a little more vulnerable, especially if that yield curve begins to flatten, and especially if if people begin to smell that the Fed's going to tighten up. I think the dollar, in terms of the price and what it's done against the euro, against Aussie, has begun to smell and price that in. And as a result of that, I'm very comfortable being short volatility on currencies in that regard, because if the market goes up again and I become more short gamma, I'm pretty cozy with the fact that the Fed is going to come in. I think that structurally I'm in pretty good shape there. Conversely, if currencies do make another leg lower, all right, longer term, I think that most of the pricing metrics has been kicked into this recent sell down here. Conversely, if they do make another leg lower again, I think that the long volatility play I have set up on the equities in terms of the S&P, the Qs, can more than make up for that play and work from there.
ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.